What's next for markets?
Jump in. All right, Jim, I am excited to have you join our podcast this week because you have been a very outspoken person on the Fed, interest rates, the macro outlook, the markets for a very long time. You and I have met each other a couple times. I think we've been on a
Yep.
panel or two together over the years, but I'm excited to have you one-on-one. Today was Jackson Hole. We saw quite a market response. Let me first ask you, what did the Fed do? And why did the market respond as it did, in your opinion?
So going into the meeting, the market was expecting the Fed to cut rates at the September meeting. The last day or two, it got a little weak-kneed. If you look at the Fed fund futures, which everybody looks at, it was about 89, 90% that they were going to cut rates earlier the week. We're recording the day at Jackson Hole, which is Friday, the 22nd of August. And then it kind of weakened to about 67% right before Powell started speaking. Now, it's still more than 50, still was expecting it. It was just getting a little bit more unsure. Powell came out and said if there might be a need for an adjustment. That's Fed speak for cut rates. And it shot right back to 90% is what the probabilities did. Now, why did he do that? He did address that there's two issues that the Fed is looking at. Issue one is inflation is too high. And I'll use the core numbers just for simplicity, at 3%. And they expect the inflation rate to go higher in the months ahead because primarily of tariffs. So expect it to go up even more. And he did admit that inflation is a yellowish to red sign for the Fed to not be cutting rates. But then at the same time, he said the labor market is a yellowish to red sign in that it is having problems too. And then he detailed the problems, and he said that the problems are both on the demand side, the ability for companies to want to hire workers, and on the supply side, the number of workers that we have. And he said, given those conflicting signals, that they're going to lean more towards the weakening labor numbers and cut rates. Now, let me point out something about that. A year ago at Jackson Hole, he said exactly the same thing for exactly the same reason, that inflation was too high and that the labor market was showing signs of weakening. A year ago, it was the SOM rule was triggered. We had this QEW, which is a quarterly revision of the payroll report that took 818,000 jobs out. And they had the conflict then of higher inflation, weaker market, and they elected not only to cut rates, but they cut rates 50 basis points at their first meeting in September last year and followed up with a full total of 100 basis points of cuts. Right after they did that, the bond market effectively rejected it because it bottomed the day before the Fed meeting at 3.6%. And by January of this year, 4 months after the first cut, it was at 485. Here we go. Wash, rinse, repeat. We're going to do it again for exactly the same reason. And we're going to hope we're going to get a different outcome this time, in that we're not going to wind up cutting rates and winding the bond market reject it and seeing interest rates go up.
So here's a question. And so I think you described why the markets were up so much today, even though I would say I don't think Powell said anything that was really surprising necessarily, given how he has spoken about the data. I think the question mark was about the labor market, which he certainly focused on. And the fact that he alluded to, hey, I know we're going to see some upward pressure on prices in the coming inflation reports is essentially all of this kind of validates investors' concerns. I almost feel like a therapist here. You don't need an answer. You just, when someone says, "Oh, my head hurts," you don't want to give them an aspirin. You want to say, "Oh, I understand how the headache. I've had a headache before."
That's macro analysis.
So I feel like that's what Powell did. Does that make the market less sensitive to, on September 11th, we get the next CPI report? Let's assume that it comes in and year on year accelerates and month on month is, let's say, at least warm. Do you think the market doesn't react as much because Powell has already highlighted that he's expecting this?
The answer is no. I think it might actually react more. Now, of course, It depends on which market you're talking about now. If you're talking about the bond market will definitely react to it, because the reaction today in the bond market was very acute at the front end of the yield curve. The 2-year yield fell. And as you got to the back end of the yield curve, it didn't fall nearly as much. The yield curve steepened. And I still think that's why didn't the 10-year and the 30-year go down as much, is because of that residual inflation fear. But yes, this will set them up to have an issue if you're right. If we get a very warm or hot employment number, payrolls in particular, and if we get an above consensus CPI number, that will really throw the whole thing that he talked about into question at that point. Now, we have to get those in order to have this
Sure.
conversation. If we don't get one of the or the other one, then this whole point is mute. But I think the bond market will react quite a bit to it. How the stock market reacts to it, that remains to be seen, because the stock market, I think, has been largely looking through a lot of these interest rate movements. Yeah, the stock market was up a lot today. Did the S&P close at a new high? I don't think it did. But if it did, it was by a very marginal amount. And I know the Dow did close by a new all-time high. But effectively, it's just back to where it was a week ago, within a couple of points. So
Yeah.
it really just undid the correction of the last week.
Yeah, you certainly saw some pretty large moves in rate sensitive names, small caps. I feel like this
Mhm.
is like the 10th event over the last 3 years where we've had, whether it was a good CPI report or a weak employment report in 23 or 24, or the Fed meeting that alluded to cutting. We've had these macro events that have caused these market shifts where we certainly get some broadening out, and
Right.
they really haven't been sustainable, though. We haven't seen small caps lead for more than maybe several weeks, large caps over the last few years. So on interest rates,
Can I
for
stop you? Can I stop
sure,
you there and ask you about small caps? So this is my take on what's been happening in the market for the last couple of years, and
okay,
especially this year.
yep,
We have seen the return of the retail trader in a big way. And the seminal event was Liberation Day. The market sold off hard. If you were a professional investor, you sold the market after Liberation Day. If you were a retail trader, you bought. And the ETF flows and everything shows it was like record inflows.
yep,
And the retail traders won because we're 30% higher than we were then. And the retail traders did the same thing after the big downdraft with the payroll report on August 1st. And if you traffic the Reddit boards, the attitude is completely different now than it was a couple of years ago. A lot of people think they want bad data. They want Tal to be hawkish. They want the market to tank because they believe every sell-off is a dip to be bought. And they want an opportunity to buy lower prices. And we've seen this time and time again, these waves and waves of money. They tend to be younger. We also see that an options trading, over half of options trading is 0 DTE options. Those are options that expire today, the same day. And
yep,
we've seen, I think, among the older crowd, maybe more of a shift towards safer investments because the ETF flows into fixed income have been very good. And the ETF and the flows into money market funds have been very good. And what I'm leading up to is the next time Barron's wants to do their big money polls, stop asking hedge fund managers what they're going to do and go tell me what's happening on the Reddit boards because they may be the big money right now. How much of that do you disagree with? Let me ask you the question that way.
I agree, and I think that, well, the data certainly show the combination of increased passive flow impacting institutional money managed, and the increase in retail investors that are not only adding brokerage accounts since COVID, but now adding options accounts on top of that. And I saw a stat yesterday, I think it may have been from the CBOE, zero DT options are up to almost 60% now. It literally just keeps going up every day in terms of option market share. So I do agree that, particularly in some of the large cap names like Tesla and other names that, whether you want to call them memes or more speculative names in the market, you're seeing a lot of volatility that I think is induced from the retail community. And if you think about the contribution of market movements, you don't necessarily have to have the most money to make the market move the most. You have to I guess, depending on the liquidity environment, trade more violently or more aggressively. Maybe I'm not articulating that the best way, but I agree with you. And I see exactly what you're seeing. I hear the sentiment on Twitter. I hear, especially around crypto, people are talking like fast forwarding into the future and saying what they're going to do with their money when Bitcoin's at this price and this is at that price. So I think that is very much the mentality. I think, particularly since COVID, we've had a market that, like a parent to a child, every mishap or problem has been taken care of by
By the adults in the room. They
the
knew
adults in the
the
room. Whether, yeah,
yeah, the Fed or the Treasury. They've really pretty
exactly.
much fixed everything.
Yeah,
Exactly. And I think that to take that one step further is the meme stocks and the speculative names in the Mag 7 or Mag 10, if you want to expand that out a little bit. They've got all kind of retail activity that are going. So now you go, all right, what about the other 490 stocks? What about the Russell 2000? And remember now, I think the market cap of the Russell 2000 collectively is smaller than NVIDIA. Oh,
sure.
to give you an idea, they would need the more traditional crowd to kind of traffic those names because you're not going to get anybody all excited on the Reddit boards, that, hey, we got to go buy Procter& and Gamble or something like that.
Yeah,
You're going to get zero interest in doing that.
sure.
You're going to get more of a traditional player that wants to buy that name. The traditional players tend to be a little bit more risk averse. And this gets to the ETF flows into fixed income. As my friend Jim Grants likes to say, who runs Grants Interest Rate Observer, we now have an interest rate to observe again. And since we do, there's all this competition for money market funds and from bond funds for stocks because the traditional investor's been trolled. The stock market will return you 8-ish% a year on average.
Yeah.
Better years, worse years, about 8-ish% a year. And then they look over and go, yeah, but a money market fund's giving me half that, 4, and it's got the same price every day. So it's got zero volatility. That's not a bad deal for some people to say, I'll take half the stock market's gains with no volatility. And for bond funds, they're up 6.5%, the bond index in the last year. I'll take 2/3 to 3/4 of what they think the stock market's going to give them, and they'll take a little bit more volatility. So that's the mentality that's driving bond funds, and maybe that kind of hole in the middle in that donut. On the one side, you got memes, the other side, you got options, that middle stuff part where the P&Gs and the Russell 2000s reside. That money is competing with the bond market right now, which is why you constantly see those small caps names, the equal weights always underperform, except for when the Mag 7 sells off because somebody didn't do something on an earnings report or something like
Yeah.
that.
Let me give you how I see it through my lens. And it's not to disagree with what you just said because there's no arbiter of fact in this discussion, this debate. In other words, I
Yeah.
think there are a lot of factors at play. Let me give you some interesting stats. So if we look at the end of the 2021, we look at the market and we look at small cap, the S&P 600, the mid cap, S&P 400, and the S&P 500. And we'll talk about the Mag 7 too. The multiples of these three indices, large, mid, and small caps, all fell tremendously in 2022 and have all been rebounding and moving up over the last few years. When you're looking at large cap, the S&P 500 versus the 600, and we all know the S&P 500 has crushed the small cap 600 over the last several years, none of it's come from multiple expansion because the multiples are all, again, from beginning of 2022 through yesterday, the percent change in the multiples of large, mid, and small caps are within basis points of each other. It's not like the S&P 500's multiples gone up 20% more than the S&P 600. They're very much up the same. And I think that's largely because multiples of these different indices all basically react somewhat more or less similarly to these macro events and macro outlook changes, whether it's rates, inflation, growth, employment. Therefore, if it's not coming from multiples, we know what the leftover is, it's earnings. And so whether you're talking about large versus small caps, or if you're talking about the Mag 7 versus the 493, what you mathematically see is that pretty much, and in the case of the Mag 7, more than 100% of its excess performance versus everything else has come from changes in earnings. In fact, Mag 7 stocks are down over that period about 20% on PEs. Therefore, the outperformance has been greater than 100% from the earnings stories. I approach that and say, look, small caps are underperforming because they've had no earnings growth in 3 years. And if you look at the S&P 600, the earnings number just keeps going down, down, and down. And those stocks are up. The IWM, the Russell 2000, is back to near all-time highs after the close on Friday. But it's just all multiple expansion. Now, earnings are expected to eventually move higher, but that's been the case for 2 years, and they just keep getting chopped away. My view on small caps, and I've been relatively bearish on that group versus large caps, is basically I think they'll start to work more sustainably and not just in a couple weeks or one day event from a macro data point or a Fed speech when their earnings start to turn around. And this comes back to interest rates because we know one of the things that are holding back smaller companies is the fact that interest rates for them are not accommodative. And that from everything from the small cap indices to NFIB small businesses. So small caps need to have their cake and eat it too to outperform sustainably, in my opinion, which is that we need lower rates, but not higher unemployment. And that kind of
Right.
brings me to the, I think, conundrum of where we are today in terms of the economy with all these pro-cyclical policies from the big, beautiful bill to low energy prices to interest rates just hanging around the levels where they've been for the last couple of years. And maybe we get some cuts now, but are we going to get enough of a cut to really help to see housing pick up, to see smaller companies broadly benefit with the rest of the economy? I think it's hard to do that. And I think the irony here is there's a lot of reflexivity. And every time we see the macro data pick up, we see interest rates go up and vice versa. So that's why I think when we talk about interest rates, I think this is now the ninth narrative on the 10-year and in terms of where consensus thinks it's going. And if we looked at a chart of the 10-year yield over the last 3 years, we really just haven't gone anywhere. We've just bounced around between 4 and 5% with some moves above 5 and below 4 for short periods of time. But really, and you talked about this today, the yield curve steepened and the 10-year really didn't come down all that much because maybe these cuts will help the economy if and when we get them in September or October. But then if we get a better economy, where's the 10-year going? And I guess it goes,
Right.
and I'll wrap this up, is that goes to the point though, is how do we get rates lower? How do we get mortgage rates lower meaningfully,
Without a
needing weakness from the economy?
Let me answer that question by giving you the two assumptions that I start with. And I like to joke that these are the two economic discussions that nobody wants to have. They all look at their shoes when you talk about them and they wish you would stop talking about them. And those are COVID and immigration. Oh, we can't talk about it, but we need to, because I would argue to you, I am a firm believer that COVID was the largest economic event of our lifetime. It was bigger than the financial crisis. It was bigger than the 87 crash or whatever else you think might have come up to this date. And the reason is that we are in a different economy now post-COVID than we were pre-COVID. The labor market is fundamentally different because of remote work post-COVID. Deglobalization is accelerated post-COVID. Tariffs are now a thing post-COVID. So when I hear the narrative, and Jay Powell is guilty of this as anybody else. Oh, we're seeing broad signs of the economy normalizing. We're seeing it return to pre-pandemic levels. That's a different cycle. That's like saying we're returning to the gold standard as far as I'm looking at. We're not going back to that narrative. And let me address the online crowd. We're not going back to zero. In fact, I think in the second part of Powell's speech about the framework review, it was a wonky part of it, but I think what he basically said is, and I'll put it in English, we in our lifetime, our kids in their lifetime, will probably never see zero interest rates again, unless you're talking about the oncoming of a true second depression. But short of that, I know everybody thinks that we live in a world now where if we wobble for a week and a half, we're going to go to zero and start printing money. That era is over. That era is a different era that ended in 2020. It'd have to be something extreme. And to talk to the online crowd, call me when the stock market's down 40%. Then we could start the discussion about whether we should go to zero interest rates. Not call me when the stock market's had 3 bad days and when's the Fed going to start cutting rates, which is what we did pre-COVID. Under that environment, that it's a different economy because of COVID, I think the biggest thing, getting back to the economics, that of remote work, deglobalization, tariffs, is we're in a higher inflationary world. We are in a 3-ish% inflationary world, not sub 2. We are at 3. By the way, here's another fun stat for you. The inflation rate's 3.1. I'm using core as my measure. We'll get one more inflation number in September, but let's just assume it'll stay at 3.1 because the number from a year ago is very low. So it probably will, unless some dramatic happens. When was the last time the Fed raised rates with the core inflation rate above 3%? It was a year ago.
Yeah.
What did interest rates do? They went up right after that because the Fed was raising rates in too high of an inflation environment. When was the last time before a year ago the Fed raised rates with inflation, core inflation above 3%? It was 1991. So it's been 34 years. What happened during that period was inflation, actually core inflation was 5 because what it was the Gulf War. For those old enough to remember, the Gulf War came, oil doubled, inflation was high, but everybody was so freaked out that we were going to have a depression, including the Fed. They were all cutting rates into this high inflationary environment. And it turned out we didn't have a recession and rates went up. So over the and then you got to go back to 1985 when we were coming off of the 15% inflation rate or 11% on core, which was what the peak was. So what the last 40 years has shown us is that 3% is an inflation rate that is just too high to be talking about cutting rates. And we're doing it yet again. And so how do you get rates down? That 3% is about to start to drift lower. But all of the mechanics of what's going to bring that down are working. Goods prices, which is usually running around 0, the goods inflation rate has historically been around 0, is moving up because of tariffs. What about services? Service inflation is driven largely by wages. So what are wages doing? This gets into a wonky discussion about immigration. And that other argument, everybody looks at their shoes and says, stop talking about immigration, because it's the single biggest driver of the labor market. The number of people that have a job, according to the payroll report, is 164 million. And then we look at the rate of change. We survey 120,000 homes to ask them who's got a job, who doesn't have a job, to get the unemployment rate. Effectively, these are population numbers. And that the biggest single driver of labor growth and the unemployment rate and the like is population growth. We have the lowest fertility rate in American history at 1.6 kids per woman. The replacement rate's 2.1. And so all population growth comes from migration. From 21 to 23, when we had 3 million people come into the country, we had the fastest growth in the country's population in at least 20 years and maybe closer to 30 or 35 years. The gates were open and everybody came flooding in. During that period, every month, thousands, maybe even hundreds of thousands in some cases, of new entrants into the country were here looking for jobs, and they were depressing wages, and they were getting more and more jobs because they're coming in, undercutting existing workers for lower wages.
Sure.
And we saw payroll growth grow. Trump comes into office and he slams the door shut, and immigration now is effectively 0. Earlier this month, he puts out a Truth Social post saying that we have net negative immigration for the first time in 50 years. Now, that means that more immigrants are leaving the country than entering. And he said 50 years. Well, the reason he said 50 years is because we only have 50 years of data. But a lot of demographers will tell you that it might be the first time, if we have net negative immigration, it might be the first time in American history that more migrants are leaving the country than entering the country. So what I'm trying to say is the population growth of the country collapsed, and it collapsed in the last 4 months because of this, to practically 0, because we still have net births, deaths, and stuff. It's one of the lowest population growths in the country, other than crises, COVID, the Spanish flu, the Civil War. You take those periods out, this is not one of those periods. This is one of the lowest population growth levels in the world. Now, Powell addressed this, and he said that the supply of labor, which he's talking about population growth, and the demand for labor have both fallen, and they're oddly in balance. Those were the words he used. What does he mean by that? What he means is, and I'll quote the American Enterprise Institute has done some work on this, and I'll bottom line it for you. In a year, any payroll number above 0 is good enough. That's all we need. All we need with this population growth is some number above 0. But then Powell opens the door to cutting rates, because it seems like yes, they've come down and they're oddly imbalanced, but we still need to cut rates because the labor market's weak. Where are you going to get these jobs? How are you going to get back to 100,000 jobs a month, 150,000 jobs a month if you don't open the border? And Trump is not opening the border. So that's just not going to happen.
Yeah.
I'll give you one other statistic. Labor market participation. That's the percentage of people between 18 and 64 that have a job. It's about 62%. The other 38% are either housewives, students, military, on disability, or are independently wealthy, don't need a job, or unemployable for some other reason. In order then to get us back to 100, 150,000 jobs a month without the population growth number, you're going to have to raise the participation rate. There's an easy way to do that. Pay more money. Just walk up to these people who don't have a job in the 38% and say, how much do I have to give you to take this job? That's wage inflation. That's more inflation. So I don't understand, if we're going to stimulate this economy, we're going to get higher goods inflation. We're not going to be able to get more growth out of the labor market without that population growth unless we get higher participation, which means more labor inflation. So we're going to get higher inflation either way. Therefore, I don't see the path for interest rates to go down or lower inflation, except if we have a recession. Then you kill demand and everything changes if you have a recession. So that's the head scratcher. And my understanding, talking to some people, is that the general sentiment at Jackson Hole and people that are keenly watching this is very mixed on his speech on the need to be cutting rates right now. Because there's a lot of people that argue what I just laid out here. We don't need to do this. And there's a lot of people that argue that we do need to do this. So there isn't a universal agreement in what we should be doing. And I think you see it in the markets. Going back to our discussion about retail and stuff like that, I think they just heard cheap money, let's go. And the market goes. And don't worry about the details. He just said go. In the bond market, the nuance in the bond market is mortgage rates are going to come down and everything. That's if the yield curve parallel shifts down. That means that as far down as short rates go, long rates fall the same amount, but they're not. The yield curve steepening, meaning that long rates aren't falling as much as short rates. So I think that mortgage relief that everybody's talking about is going to be a little bit short-lived. Can I go off one other quick tangent here, and I'll make this as short as possible?
Sure.
About the housing market and about the crisis in the housing market. Let me say this. Every single day I've been alive, you've been alive, and every single day we have been alive, we are going to be alive, the housing market will be in a crisis because it's always in one of two states. It's either the home prices are going up and we have a affordability crisis, or home prices are falling like 2008 and we have a financial crisis. Right now, home prices are going up. We have an affordability crisis. Why do we have an affordability crisis? I got in a Twitter spat with a bunch of people over the weekend about this, and I said, here's why we have an affordability crisis. The price of homes in the United States is at an all-time high at $435,000 a home. That's too high. It takes $120,000 for an income to qualify for a mortgage. There's your affordability crisis. And then I say, here's the way you got to fix it. You got to make home prices go down. And then I say, okay, how do you make home prices go down? Housing starts have been 1/3 below their pre-2006 level now for 15 years. We don't have enough housing units. We need to be building more houses. And I said, and this is where everybody got mad at me. I said, because this is the way it works. Boomer moves to Arizona. Boomer moves to Florida or Tennessee or Texas. Boomer buys a house. Boomers, not the same boomer, go to zoning board meetings and say, no more houses in my neighborhood.
Sure.
NIMBY. No more
NIMBY.
houses, building codes, land use. The only house that people can buy in my neighborhood is my house, and I'm watching it go up on Redfin or Zillow every day. Thank you very much. And so I said, look, we got to just let these builders build more homes. And the tidal wave, no, my house doesn't have to go down in price. You cut mortgage rates. It's Jay Powell's fault. It's BlackRock's fault for buying all these houses and renting them. It's this person's fault. It's that person's fault. It's not. You have to fix the house. Here's what you have to do. You have to take my $435,000 house and make it go to $500,000 and make everybody be able to afford it at $500,000.
Yeah.
That's what everybody wants. So what I think the problem is, there's not enough supply of homes And
Sure.
that's why that's why we have a affordability crisis. And why do I bring all this up? Because if mortgage rates go down, all home sellers are going to do is raise their price, and we're going to be back to the same monthly payment. We're not going to accomplish anything. They're going to say, oh, you got a cheaper mortgage? Then I could ask more for my home. That's all we're going to wind up doing in this environment. We're not going to fix it through lower mortgage rates. I think the bond market knows it. And I think that's why we're going to be collectively disappointed in how much mortgage rates go
Yeah.
down.
I agree with you in part to that last point, and that's, I think, an aspect of reflexivity that we're seeing in not only in housing but in many parts of the economy. However, I think we have to acknowledge that when we look across the country, you've started to see quite a bit of bifurcation and differentiation within different housing markets, where some
Mhm.
areas where there's plenty of inventory and prices are falling. And then if you look at the tri-state area, if you look at the Midwest parts of it, there's not been a big increase in basically wherever there's still inventory problems, you still have high prices and they're not falling.
What's interesting about where you have plenty of inventory, you probably have it in Florida and some of the other places
Sure.
where a builder would tell you it's the easiest place to build a house. That you go to the tri-state area, you go to the Chicagoland area, and you say, I want to build a house. First of all, you probably have to buy a lot with an existing house in it and knock it down,
Sure.
because it's all built out. They will talk to you for hours about the regulations and the rules and the zoning and everything else. In Florida, there's an empty piece of dirt. You could bring the tractors in tomorrow and get going. And so that's why you've got an inventory problem there. And then you don't have the inventory problems everywhere else. If they were to actually take in the Midwest and the Northeast and say, that crappy house 3 doors down from us, that knock it down and build another house. But nobody wants that to happen because then it competes with my house when it goes on the market. And that's why we're caught in this problem.
Yeah, I agree. And this is certainly a lot of what you're saying, and I've heard you say, is particularly with the reaction function of the Fed and thinking about the job market and your points there. People want us to go back to some kind of normal. And you've been doing this longer than I have. I'm not dating you, but we've both been doing this for a long time. I don't know when I realized it, but it wasn't too long into my career that there is no such thing as normal. How much history do we really have, and how different were the 70s to the 80s to the 90s to today? So there is no such thing as normal. I think normal tends to be more of recency bias rather than the average of history, which is not much of it really.
And also, the recency bias can be so extreme. In Powell's speech today, he talked about, when I spoke here last year, we were at an inflection point. And then I was watching Bloomberg TV, and they brought in some former Fed officials. I won't name them to protect the innocent. But then they said, this might be the most uncertain time I've seen in my career today. I'm like, you look pretty old. I think you remember 5 years ago with COVID when we shut down the global economy and lost 20 million jobs a month. And you're saying today is the most uncertain period you've ever seen?
Yeah.
You got to be kidding me. You got to be kidding me. But my point is, you're right. We always think, and like when Powell said, I sat here last year and it was an inflection point. Last year was an inflection point? No, 2020 was an inflection point. 2009 was an inflection point.
Yeah.
I don't know what the hell last year was, but it wasn't an inflection point. So we always say this about the market, right? That it's in some form of flux and it's in some form of change and all of this other stuff, and that it's unusual. No, that's the way it always is. And we're always trying to go back to pre-COVID. We always want to go back to some period that we think we had figured out, but we never do. We're always evolving into some other period.
Let me ask you a question. What's your view on interest rates? Because I think you do some great work. You articulate your views really well. So I'm really curious to hear your answer. And there's been a lot of strong opinions on long-term yields. And in a way, I want to say both extreme views on rates have been wrong in the last couple of years.
Yep.
And not too many people are saying yields are just going to hang around 430 with a little volatility. So what's your view? What I hear from what you're saying about the labor market and the economy is you're probably expecting long rates to not go much lower. Is that fair?
Today we had a decent sized move in the bond market, but if you look at a chart in the last 6 months, and I'm thinking of the 30-year in my head too, more than the 10-year, but the 10-year applies. We're right in the middle of a sideways. We're not only in a sideways market for the last 5 months, We're right in the middle of the sideways market of the last 5 months. Bond yields rallied today to the lowest level since last Friday. That's all they've done. They're just basically at the level that they were a week ago. We could keep going sideways. And you're absolutely right. The big call in the bond market was to say it's going to do a bunch of nothing. And because there's cases to be made that rates are going to go up, cases to be made that rates are going to go down, and they don't. They just go sideways. And if you look at the MOVE index, just to quote you one other statistic for those that are not familiar, the MOVE is the Merrill Option Volatility Estimate. It's developed by Harley Bassman. It's the VIX of the bond market. It's at a 2.5-year low right now. So the bond market has been sleeping nicely or on the beach reading a book, and it hasn't been doing much of anything. The observation is we've been talking about the Fed cutting rates. The Fed's going to cut rates. The Fed has told us that they're worried about the labor market. And what's the bond market's reaction to all of this is nothing. It isn't doing anything with this news. It's not getting excited about it. It's not agreeing with it. It's not doing anything. Now, the reason I would argue that it isn't is it's at fair value. It's roughly where it should be, despite what President Trump thinks. And that's why it's not been going anywhere. Now, what we probably need for the next big move is a move in the economy. Does inflation heat up? Does the economy stay? Does nominal growth start to move into the 5 range and then interest rates can go up solidly into the 5 range? Or does it weaken down into the 3 range and interest rates could start moving down into the 3 range? My call has been for a while that I do ultimately think it's going to go more towards the 5 range. I think we're going to see a 3-ish sticky on inflation, services inflation, goods inflation. We're going to see that 3% handle hold on inflation. We're going to see no recession. We're going to realize that Powell was right. Supply and demand for labor came down. They're still in balance. If you have nobody coming into the country and you have no population growth, you don't need to create any jobs. All you're going to need then, where's your growth going to come from? Productivity. That's what gives you your real growth then is productivity. And if the AI crowd is right, and we do get productivity from AI, and count me as one that thinks that's probably going to happen, then you're going to get higher growth and then you're going to see interest rates move up. Let me make a quick comment about that AI growth. In 1996, Bill Gates had a great line about technological advance. And he said, over the next 3 or so years, it will deliver less than what you think. And over the next 10 to more years, it's going to deliver more than what you think. And I think that perfectly described the internet in the early days. And I think it's going to describe AI. I think we're going to be disappointed in the next year or 2 or 3 as to what we get out of AI. But I think in the next 10 years, it's going to be as transformative as the internet itself. But it's going to take a little bit more time. So if you get that productivity increase eventually to come, that will be a push up in rates right there. But right now, the bond market's saying, where should the 10-year trade? 4.5 to 5. Where is it now? It's 430. It was 440 2 days ago. Close enough for government work. There's really nothing for us to do here. And so it just continues to churn sideways, waiting for the next resolution. Is the economy going up or is the economy going down?
There's so much talk about what's driving the bond market. I haven't heard many people talk about deficits, but that was obviously something that's all people were talking about at times over the last couple of years.
That's definitely there.
Yeah. It flares up when rates go up. That's for sure.
And what I mean by it's a constant in the background is we have a deficit problem or a debt problem today. We had it a year ago. We had it 5 years ago. We're going to have it in a year. And we're going to have it in 5 years.
Yeah.
So there shouldn't be ever a headline that, oh, the bond market sold off because we have a deficit problem. Yeah. A better argument is it can't get under 4 no matter what because we have a deficit problem. I'm talking about the 10-year yield. It really can't get under 4 despite, other than when we're freaking out during Liberation Day for a couple of days, because of the deficit problem. That's really where it matters.
Let me ask you to clarify that. When you say, do you mean deficit problem or do you mean debt problem? And do you see them being one and the same?
There's a better word to use there, and I meant supply. I meant the amount of bonds that have to be issued, the amount of take that the Treasury is demanding from the private sector to fund the U.S. government. That's huge. That is running at about $1 trillion plus a quarter, all in. Right now, they're going to issue $1 trillion this quarter. of debt. And that means that there's going to be a huge amount of bond issuance or supply. There's an old saying in the bond market, there are no bad bonds, there's only bad prices. And then what that means is that people always ask me, what happens when there's going to be a failed auction? And I said, there will never, ever be a failed auction. You might have to issue them at 20%, but they'll get issued. There will always be a buyer if the yield is right. And that's what I mean by that there's only bad prices. Lower the price and people will buy them because they'll have higher yields. The supply of bonds that have to be issued keep that yield up. You can't start really bringing the yield down. And all this talk about twisting, that they'll issue more bills and they'll issue less 10-year notes. They had their quarterly refunding announcement in August and they didn't do any of that. And Trump had already started making noise about maybe we should stop issuing 10-year notes and only issue treasury bills, trillions of dollars of them. And then the Fed will cut rates to 1%, and then we could refinance at 1% and save a ton of money. Okay, other than I don't think you could do that. The capital markets couldn't handle that kind of a change. You didn't when you had your chance to do it. So we could put that argument to bed.
Yeah. All right, Jim, this was a really interesting conversation. One of my observations over the last few years is that it seems that we have had very opposing bond yield narratives or outlooks about every 4 months. It seems to have gone in cycles over the last 3 years. If you look at that chart of the 10-year, every 3 to 4 months, we've hit a peak or a trough in yields, around 5%, down to 360, back up to the high fours. I wouldn't be surprised before this year's over, there is another inflation scare. There is another concern around the debt and the deficit. We do see some more weakness in the bond market, whether it comes from better growth or a combination of growth that's okay and some upside inflation pressures that comes along with that, plus any tariff pass through.
Yeah, and I'll also point out one other quick thing for people to think about with the bond market. From August of 2020, the 10-year yield hit 50 basis points, the lowest ever. And then by October of 23, it hit 5%. During that period, we had 9% inflation and the Fed raised rates from 0 to 5 inside a year. We had to get interest rates off of 0 and we had to go to 5%. That produced horrific losses for bond investors. Bond indexes were down 15 or 18%, which, as a matter of fact, there's some bond indices that go back 200 years. And the rolling 3-year period for bonds from that 20 to 23 period was like the worst period in like over 150 years in the bond market. That was a scarring event for a lot of people. And you'll still see people bring that up. If you've seen what bonds have done over the last 5 years, it's been just this horror. Yeah, because 20 to 23, we had to get interest rates off of 0. We got them to 5% by October of 23. That period's behind us now. But that's why you said since October to 23, to go technician on you, we've been consolidating that massive move. That is a massive move in bonds. We've been consolidating that move for the last couple of years, waiting for the next resolution of that long consolidation in which we go. I happen to think it'll be higher in yields, but that still might be 2 years away. And you're right, we still might revisit 350 before we get there. Or it might be much closer than that. It might be this fall. But I do think that ultimately that scarring event for bond investors, holy crap, I wasn't supposed to lose this much money in the bond market. Yeah, if you own them at 0 and we get inflation and the Fed has to raise rates 400 basis points in a year, you're going to get equity tech stock kind of losses in the bond market. And that's what you got.
That was long duration on steroids. So interesting to speak with you. And it's always good to speak with someone else in the industry who looks at things from different lenses and has different experiences that I could certainly learn from. I really enjoyed this conversation and would love to have you on again.
I really enjoyed it, Michael. I'd love to continue this conversation.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Kantrow. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.